Investing can be fun, and it can actually make you very successful. However, everyone knows that investing is extremely risky. And this graph over here highlights some of the greatest stock market drawdowns since 1929 all the way up to now. A drawdown means a percentage decrease from the recent highs of the stock market. For example, in the Great Depression, the stock market dropped around 83.4%. In the financial crisis of 2007, it dropped around 56.8% from all-time highs. And at COVID-19, it dropped around 33.8% from all-time highs. Now there are tens and hundreds of examples like this ones, and they are all caused by something remotely different. However, most these drawdowns have something in common, that they were the consequence of stock market bubbles. And as Seth Klarman says, you must always be prepared for the unexpected, including sharp downward swings in markets. Whatever adverse scenario you can contemplate, reality can be far worse. But if all these drawdowns come from bubbles, surely we have figured out how to detect them. We'll be looking at that today. What we do know is that the stages of a stock market bubble are typically similar. It all starts with displacement, a new technology such as, for example, AI, which starts to draw some hype in the market. This, of course, then funnels a boom, euphoria, and it reaches its peak. What this basically means is that prices have been growing consistently, valuations are out of hand, prices have been increasing constantly despite news not reflecting that the economy is doing that well, and then all of that actually settles, and there eventually is a collapse, which leads to the drawdowns that we have seen previously. This relates to the following quote, where booms start with some tie-in to reality, some reason which justifies the increase in asset values, but then the market loses touch with reality. Today we'll be looking at some common factors which could signal a stock market bubble, some KPIs that can actually let you know whether we're closing in on a stock market bubble or not. Now, one thing you must keep in mind is that most super investors don't actually believe that it's possible to accurately signal a stock market bubble constantly. However, some of these indicators, when combined, can give you a sort of reasonable understanding whether we are closing in on a bubble or not. The first one is the Buffett indicator. It was not created by Buffett, but he was a firm believer of it, and it's why it gained his name. Then we have the Schiller Cape ratio, the price to earnings ratio of the whole market, the CBOE volatility index, which is commonly referred to as the fear or greed index. Then we have prices rising despite the news that come out, unreasonable M&A transactions. There is a quote here that it says that exceptionally bad M&A transactions happen at the top of a market bubble. Then we also have the irrational IPO market, where when there's an IPO, the stock price for that company rises over 100% in that same day, or when an asset class becomes trendy. We saw this happen with cryptocurrencies, where they were everywhere on social media, everyone was speaking about it, and almost everyone owned a crypto or two. And then, of course, the collapse came, and the cryptos lost a lot of value in just a few days. We'll be focusing on the Buffett indicator and the Schiller Cape ratio for this video, since they're the two that I found were most commonly used. The first one, the Buffett indicator, is a calculation of the total US stock market value, which is the total market cap over the gross domestic product of the US, the GDP. As we can see, that value gives a percentage, which is the blue line in the graph. The gray line in the middle is the trend of this ratio, and then the other lines are 1 standard deviation above or below and 2 standard deviation above or below. And as we can see, this ratio actually rises very quickly during bubbles. There was one in 1970s, there was one in the 2000s, and there was one in 2020. All these 3 points were above 2 standard deviations from the trend, and in all of these cases, the bubble collapsed. Warren Buffett actually called this the best single measure of where valuations stand at any given moment. However, he is a strong believer that not only one valuation should be used to figure out whether we are in a bubble or not. So we can also move on to the Schiller Cape ratio, which is calculated by getting the current price of the S&P 500, for example, and dividing this by the average inflation-adjusted 10-year EPS. This again is fairly accurate at calculating where there will be a boom. For example, it rose sharply in 1929, where they were in a boom, and this caused a giant stock market crash. Then this also rose to all-time highs before the dot-com bubble burst in the year 2000. And as Warren Buffett said, managers and investors alike must understand that accounting numbers are the beginning, not the end of business valuation. So you could see that currently we're in a 34.47 and believe that we're in a bubble. But when you see that earnings are at an all-time high, that currently in 1 year there are more investor inflows than in 5 years in the 1900s, that the economic conditions are extremely stable, that there is the expectation of interest rates declining soon, you have to take all those values into account and mix them up with the numbers that are indicated by the buffer indicator, by the Schiller Cape ratio, by the CBO volatility index. And one thing that Warren Buffett and all the other investors are very big believers of is that you shouldn't try to anticipate market corrections. This graph over here shows the value of $10,000 invested in the S&P 500 if you invested it in 2003. If you kept your initial investment and you never touched it, in 2022, you would have had over 6 times your money, with a total return of close to $65,000. Now imagine that you missed out on the 10 best days in those 19 years. Well, your total returns would drop to only close to $30,000. You would have made less than half just by missing 10 days. And the fact is that 7 out of the 10 best days took place in bear markets. So even if you were completely right at calculating the bear markets, you would have missed 7 of the best 10 days in investing. Now this goes on, and if you missed the best 40 days, now you're actually in the negative. So as Peter Lynch once said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. I remember that at the start of my investing career, I had this problem. I wanted to invest into the S&P 500, but I wasn't sure when to invest in it because it seemed extremely overvalued to my standards, so I would just wait for the perfect entry point. And of course, I never got my perfect entry point. And in those 3 to 4 months, the S&P 500 had risen over 13%. That is money that has been lost by just me trying to anticipate a correction. But I have changed my strategy since then. Right now, my investment strategy consists in owning individual stocks, which I buy when I believe they're undervalued, that are long-term investments, that have improving fundamentals, and that will help me to sleep well at night. When I see that there are corrections in the prices of these stocks, and I decide to buy when everyone else is selling. Because as Warren Buffett said, you have to be greedy when others are fearful. When everyone is selling and you see a sea of red, you should be aiming to buy because you're buying the same stock you were buying previously, but now it's at an even better price, so you should be liking it more. However, this is tough, and it does take guts to look at your portfolio, beat down a couple $1,000s, and decide to invest more into it. I've been investing for a long time and every single time is hard. However, this is the strategy that works for me. And your first step in your investment career should be to develop the strategy that works for you, whether you want to anticipate market corrections or whether you want to develop your own strategy for the long term. As Seth Klarman once said, ultimately, nothing should be more important to investors than the ability to sleep soundly at night. And there are no rights or wrongs in investing. It's just what works for you. So thank you for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.